Good morning, everyone. Thank you for coming along. My name is Geoff Wilson, and I am the founder and chair of Wilson Asset Management. You'll notice there's a number of other people which have name tags and maybe dressed in suits. They are the other staff at Wilson Asset Management, and please make yourself known to them. We've got quite a bit of entertainment for you today. Someone said, why do you come along here? And they say, look, I to learn about investing, but also we like the entertainment. So let's hope we can deliver. Our expectations are high. So first of all, I'd like to acknowledge the traditional owners, the Gadigal people of the Eora Nation, and pay my respects to elders past and present. There's a disclaimer on the screen. If you can read that, broadly it's saying we just give you general advice. There's no specific advice. Also, if everyone can fill out the surveys, because we're only here because you allow us to be here. We're managing the money in the various listed investment companies or trust structures for you guys. So please, give us your feedback. In terms of today, you'll be hearing from the investment team on the outlooks, some stock picks and various portfolio themes. Also, in terms of the agenda is split up before lunch and after lunch. We'll go through all the WAM portfolio managers and we'll open up for Q&A. We'll have that, and then we'll move on to Future Generation, which Carolyn Gurney will have some of the social impact partners and pro bono fund managers. Then at 12:30 we have the little break for lunch. And in terms of lunch, someone was reminding me of, I think it was the first WAM Capital, AGM, which was in Macquarie Street in History House. I think we paid $60 to rent it out for the few hours. And then afterwards we gave you donuts, and the donuts were rock hard. And they were saying how things have improved significantly. So, so lunch, which should be enjoyable. So that's a 45-minute break, and then at 1:15 we're back in here in the investment game, investment royalty, and that's James Thompson, who every day when you pick up the Financial Review and you read the back page, Chanticleer, he's one of the two. He's the senior Chanticleer writer, and with a couple of other fund managers and myself, and we're talking about what's happening in the market. So it's a really we've got a lot to do today. Why are you all here? Not only to find out what's happening in the market, also to have your money with our money and buy undervalued growth companies and buy them. That's what we do. We actively manage the money on your behalf. Now, who here, put your hand up, who's a bit nervous about the market at the moment? Okay. Yeah, so my hand's up as well. Well, actually, thank you very much. This is another thing, casting your mind back, anyone who may have put their money in the WAM Capital IPO, which was 26 odd years ago, I think when we're encouraging people to pick up the prospectuses because we didn't think we'd raise much money, we ended up being oversubscribed, but we had the prospectus outside, and I think I put a $20 note in one of the prospectuses, and I said, when you take your prospectus, someone will be the lucky one and win a $20 note. Now, obviously these days, that's probably not acceptable. So we didn't do that. But in someone's prospectus is this. So when you open your prospectus, and that's the WAM Income Maximiser prospectus, and it's free lunch. The guy said, lunch with you, and I said, hey, they mightn't want to have lunch with me. Because I don't invest the money anymore, it's everyone else. The 20 other investment professionals with 250 years of experience that are investing the money. So whoever gets this, it's in their prospectus, then they've got a choice to have lunch with whoever they want on the investment team. So, but in terms of just getting back to the market, like I'm nervous about the market. Someone was talking to me earlier, asked me when I bought my first stock, and it was actually, the scary thing is, it was half a century ago. I mean, we're getting old now. And there's a number of people here with a lot of experience, and we've all seen cycles. I remember when I started Wilson Asset Management in the early days, with the global financial crisis. We were incredibly nervous about the market. I think we'd moved the portfolio to 40% cash. We were 60% long equities, and we went 40% short. So we only had 20% exposure to the market. Then the market bottomed, and initially we got it wrong. And we're professionals investing in the market. And Catriona, who runs the Global Fund, who you'll hear from after me, gave us all a book a couple of years ago, and in there it talked about investing in the market. Is it timing of the market, or is it time in the market? And when I was younger, I sort of always believed it was timing of the market. And in this book, it talked about if you invested in the US market sort of 20 years ago, and all you missed was the best one day for the next 20 years, then your performance over that period would have been zero. If you're in that market for those best 20 days, then the performance was between 8 and 10%. Now, I asked you earlier who's nervous about the market. We're all nervous about the market at the moment. There's a lot of volatility, but in these times you've got to sort of draw on your deep experience, your patience, and realise these are investing opportunities. We'll talk a little bit later about what our view is of the market. Our view is this volatility will continue for the next couple of months while there's the resetting. A lot of the uncertainty, which is still there, is removed. And then medium term, we don't think there are any signs that says that we should be significantly worried. So that's sort of trying to put that into perspective. But in terms of drilling down in the details, you'll hear from the other guys a little later. In terms of, I mentioned the prospectus. It's for WAM Income Maximiser. Why are we giving you the prospectus, or why are we raising the money for WAM Income Maximiser? Really, over the last probably decade, there's been an increased demand for monthly income, sort of regular, sort of slightly lower risk monthly income. And for us is, we've had a blank sheet of paper and we've created a product which can provide monthly, a growing stream of monthly income franked, and from our perspective, has actually significantly reduces the risk of the market. Like, I think over the last 12 months, the volatility in the market's been about 15%. And in terms of the paper portfolio of Income Maximiser is nearly half that. So, but in terms of that, we'll go through that in a bit more detail a little later. Now, what else have I got? I think it's now I'd like to introduce Catriona from WAM Global, who'll take you through the next part of the presentation. Thank you.
Thanks, Geoff. Trump's actions on tariffs, government budget cuts, and geopolitics are causing uncertainty around the world, as Geoff alluded to. But the important thing to remember is we've been here before and there will always be noise. Here are a selection of headlines we've taken from various news publications. Now, you might quite reasonably assume that these headlines are from the past few weeks. Actually, they're from 7 years ago, the last time Trump was president. Investors who chose to exit the market at that time would have missed out on significant returns. A testament to what Geoff was saying, what is more important is time in the market than trying to time the market. In managing the WAM Global portfolio, we think about this from two perspectives. Firstly, the portfolio is exposed to a number of multi-year thematic tailwinds which will continue well beyond any Trump administration. And then secondly, how do we capitalize on the short-term volatility and find opportunities? Here is a selection of the multi-year tailwinds that the portfolio is exposed to and a number of the holdings below that we own that give us exposure to these thematics. Let me dig into a couple of these in more context, with more context. Firstly, the exchanges. We own CME, ICE, Market Access, and TradeWeb. Now, exchanges are great examples of winner-take-all businesses that actually benefit from volatility. We own them for the long-term structural trend of assets being electronified on market. These businesses operate exchanges that trade commodities such commodities, equities, fixed income, currencies. They don't care what the direction of prices is, more that they're just clipping the ticket every time someone trades. What we love about these businesses right now is that they're actually, as I said, benefiting from the volatility. And this was really shown last month when we caught up with CME Group, and they said they'd had their best trading day ever in late February amidst all the tariff announcements, saying they'd traded over $1 trillion in notional value as customers tried to hedge their risk at this time. And this is a business which has been around since the 1890s. Another area it would be remiss not to discuss is artificial intelligence. At last year's roadshow, we talked to you because at that time and over the last few years, it's clearly been a very hot topic across markets and across the world. Headlines like this have been through the papers. What we cautioned last year was that we did think this was a real technological breakthrough, but we cautioned about getting too caught up in the hype and how important it was to maintain valuation discipline and stick to our process when we were looking for exposures in this area. More recently, we've seen headlines like this, such as news around DeepSeek in January, and at recent results, concern around data center overbuild. Pleasingly, the exposures we have in the portfolio to artificial intelligence, such as SAP and Intuit, they've continued to deliver really strong growth, even despite all the noise. So we will continue to remain having exposure in the portfolio to artificial intelligence, but we'll do this, as I said, in a very disciplined and valuation-aware way. Now, both the exchanges and our exposures to artificial intelligence are great examples of where there are multi-year tailwinds, which, as I said, will continue beyond any Trump presidency. Let's turn to the other area I said that we think about the current markets from, and that is how do we capitalize on short-term volatility and how do we take advantage of this? A big part of what we do at WAM Global and across the Wilson Asset Management business is getting in front of management teams around the world. Over the years, we've met thousands of CEOs and CFOs, and we use the information we gain from speaking to them, from their customers, from the competitors, to decide where a business is at that particular point in time, how we think the management team is leading that business, what we think of the strategy that they've laid out. In the last 2 months, the team has been traveling extensively and has seen over 140 companies across the US and Europe. And this gives us a really good read on what is happening right now and how businesses are dealing with volatility, how they are seeing the impacts of what Trump's discussing in terms of tariffs, etc. But what we use it mostly for is trying to find new opportunities and where we can capitalize. And I'll give you a couple of examples of where we've done this more recently. First, RB Global. So this business is in the marketplaces area of our thematic drivers and operates auctions for the buying and selling of used equipment in the construction and agricultural equipment area, and also the selling of salvage vehicles by auto insurers. It's a great example of a business that is winning again right now. In times where the economic outlook is unclear, you see more buyers and sellers of equipment, and our recent meeting with the management team last month really highlighted that. We first bought this business in early 2024 on the catalyst of a change in management. We viewed that the new CEO at that point coming in, Jim Kessler, was the right person to lead that business. And what's pleasing in catching up with the management team more recently is that the executing that he's done along the way has been exceptional. We think they've had some very interesting recent wins, including Suncorp in Australia in their autos business, and there's a clear path around streamlining costs that we think will provide ongoing catalysts for the business going forward. The next stock I will talk to you about is a more recent addition to the portfolio, and it is a beneficiary of the humanification of pets. Call me old-fashioned, but the pets that we had growing up slept outside and ate scraps and leftovers. This is a far cry from many of the pets around the world today. It is not uncommon to see images like this, particularly having just come from living in New York and Manhattan. Dog prams and cat prams are quite a common occurrence. Even pets on anti-anxiety meds, pets with weighted blankets, noise-cancelling headphones. It sounds ridiculous, but the pet industry has certainly been booming in recent years. And what's pleasing is that veterinary advances have actually, since 2010, led to the average age of dogs and cats increasing by 2 years. So they've gone from 11 years to 13 years. This leads me to talking about IDEXX Laboratories. So this business, pets, as we know, can't tell us what's wrong. And so veterinary advances would not be possible without the use of diagnostic tests. IDEXX are the global leader in the production of the equipment that is used for diagnostic tests and the consumables that go alongside this. This is a business we've admired for many years, hadn't bought on valuation grounds, but a great example of a business where we've been given the opportunity to buy it because of short-term volatility. We recently caught up with the management team last month in the US, and we think the long-term fundamentals for this business are very strong. The management team is extremely high quality, and we think, as I said, it's a great opportunity we've been given to capitalise on the short-term volatility and buy this stock and add it to the WAM Global portfolio. So both RB Global and IDEX are examples of where being nimble, being able to be on the ground, and our experience in reading management teams has given us an opportunity. Stepping back, what you can expect from us going forward is that we will continue to be disciplined around our process, that we will leverage our experience and on-the-ground insights to make informed decisions, and that we will be nimble to capitalise on short-term opportunities. In an ever-changing landscape, we think there's never been a better time for active management. With that, I'll hand over to Matt, who's the lead portfolio manager for WAM Leaders.
Great. Thank you. Thank you, Catriona, and good morning, everyone. When Geoff did that survey of who's nervous, it really got me thinking. So I had a whole lot of slides to talk about, but why don't we spend a little bit of time on why is everyone nervous? And the one thing I want to tell you is financial markets are nervous, and that's why we're seeing the sell-off. So you're not alone. Everyone is nervous, and why are we nervous? So I want to give you some insight to how fund managers think about this period. Also, how do we react? How do we take advantage of this period? So we did have some slides, but let's spend more time on that. So probably the most positive thing to say about last year was it was ridiculous. We had a momentum market. And when does momentum markets do well? It does well when there's low volatility, when there's low levels of uncertainty and reasonable levels of global growth. So what has changed? Uncertainty has spiked, and inflation expectations are all over the place. Inflation expectations are the worst since the 1970s. So people are confused. Is inflation going to go up with tariffs, or will it go down with slower economic growth? The debate is unsettled. So when debates are unsettled, markets get nervous. Inflation is not resolved. The slowdown from tariffs is not resolved. So these levels of uncertainty drive down risk assets, which are equities. But the good news is a lot of heavy lifting has been done. Is there more to go? Well, we've got the Liberation Day tonight in the US, where we find out. Will tariffs be resolved? We don't know. No one knows what Trump's going to say. But we have done a lot of work. So rather than get nervous, we are actually excited about this period because we are going from a very silly market where the only factor that worked last year was momentum. So momentum is a strategy where you buy the winners and sell the losers. Doesn't require much thought process. That was the most dominant factor last year. So this chart is showing that factor. Momentum last year completely dominated all factors. The only thing you needed to do was buy winners, sell losers. This works in low volatility. So what we're seeing in this first quarter is a massive unwind of momentum, which has been caused by a spike in uncertainty and inflation expectations. So the crowded trade is over. We are in a regime shift. A regime shift can be painful, but it's presenting great opportunities for us. Regime shifts like this is the greatest environment for active management. Last year wasn't great for active management because these passive styles of really no thought process around buying the winners, sell the losers dominated. So we're actually in a great period for active management. The volatility presents opportunities. So what's working in this environment? High dividend yield, quality. They are the two factors which is the market pivoting back to, which is great for us. And I'll give you some insight to how we're trying to take advantage of that at the moment as well. But I touched on it, uncertainty. So here is a lot of squiggly lines, but you can see higher line means higher uncertainty. So what happens when you have higher levels of uncertainty? All the previous trades that were working are unwinding. So until uncertainty gets resolved, last year's trades will not work. People will go back to quality. They'll go back to high dividend yield. High dividend yield gives you a positive carry, meaning you get paid while you wait in the form of dividends, more so than the capital growth. So that strategy is working. And within WAM Leaders, we are pivoting back to that strategy of high quality, high dividend yield. They are two factors where we think will dominate over the next period, and also defensive companies. So what are people uncertain about? I talked about inflation expectations. I think if we polled the room, everyone would have different inflation expectations. Previously, post-GFC, everyone would be inflation's 2%. In the central bank band, we know it's 2%, 2 to 3%, no issues. Now, people are like, it's going to be 1%, it's going to be 10%. Huge amount of uncertainty around inflation expectations. So when will this get resolved? When the market sees the data coming through. So tariffs, in our view, is short-term inflationary, medium, long-term deflationary because of the impact to global growth. So this is not resolved, probably won't get resolved for another 3 to 6 months. But that doesn't mean the market will not overshoot in the other direction too. The one thing we're actually getting excited about is China, which in a global growth slowdown, it will have some headwinds, but China has been effectively absent from capital inflow for 5 years. Global capital is not going into China, basically because the government was locking the country down after COVID, and they were trying to deleverage their property market. So I was up there in November. There was early signs of that deleveraging coming to an end. Recent feedback from people last week on the ground in China was the property market is starting to look quite attractive again, which is a huge change. And you know, the way we take advantage of that through the ASX is really around commodities. So for us, commodities like Rio Tinto look really good, cognizant of a slowing environment, but companies like that, we think over the next 3 to 5 years, will be really positively disposed to this increasing activity in the Chinese property market. And Australian inflation, like when we look at inflation, we think Australian inflation is largely done now, it's settled. But again, this tariff uncertainty, what the tariff uncertainty does as well is central banks get quite scared. They move back to this thing called data dependency because they don't know. So they wait to see the data, react ex ante, like post the event. It's not helpful, but in periods of uncertainty, that's what they do, data dependency. So they will be on hold on the cutting cycle. Within Australia, I think there's 2 cuts priced into the forward market. That's probably okay. But we think the neutral rate in Australia is about 3.5%. We think they will be not going to the neutral rate because they'll be too scared of this uncertainty in the short term around inflation. So eventually, you know, using rule-based programs, we think they can cut more, but we don't think they'll cut because of this inflation uncertainty, which I think if you watched Michelle yesterday, flagging around that uncertainty. And again, valuation risk, you always got to look, where are we coming from? We were coming from really elevated valuations. So when you're at high valuations, your tolerance for shocks is really low, and we got a shock. That's what you're seeing now. So how do you navigate this environment? So the way we look at it through various lenses, we think probably the safest way we think you can navigate through this period is around some of these bond proxies, which are really the defensive companies. So things like APA look really good for us. Transurban, even TLC, the lottery company, do really well through different periods of the economy as well. Because we think we are in a slowdown phase. Telstra we really like. I think we talked about it last year. They've got the big T30 program coming out this year as well, where they announced their plan to 2030. So we think there's a significant catalyst for those guys as well. ResMed we like in the US. Sleep apnea, GLP-1 didn't destroy the business. It's actually been good. So we think that's a good company to position to. A couple of the others there, like IAG, the insurers, we think are good. IAG in particular, we think they've gone very conservative on their reinsurance program. So we think IAG is a really good company as well to be invested through this period. A couple of the others, we think the REIT space is really interesting too. So REITs really haven't rallied with softening interest rate cycle. So we think on that side, the REITs on the non-transactional REIT side look really interesting as well. So for us, you stay away from momentum, go back to quality and value. And this market is actually really good because we think we're moving back to fundamentals, which was largely absent last year. And a great example of momentum is, we always talk about, but like CBA, I'm not sure anyone in this room would have picked the CBA share price as of a few months ago. That's an example of where momentum gets carried away. It totally divorces itself from reality. And that's what we're seeing at the moment, that fundamental shift back to earnings and valuation, which is a welcome development. We want to get away from that momentum market, which is what we're seeing now. So I guess the summary is, yeah, be nervous, but there is a lot of resolution to be done over the next few months. We think central banks will come back to the cutting cycle table once they get comfort around inflation. So we think the next few months is going to be volatile, but we think absent a recession, which again, our odds of recession have increased, but it's very, very low compared to history. Like you might see in the press, recession odds have gone up to 35%, but they generally stick around 25% anyway through all cycles because there's always a risk. So we think when we get resolution to these big questions, inflation and growth, equity markets will find a bottom. So the summary is be nervous, but there's great opportunities coming as well. So that's all I had. Thank you. I'll hand over to Oscar now.
No, you're right. Thanks, Matt, and good morning, everyone. Now, artificial intelligence, or AI, was a massive theme last year, as you can see in that photo. So we decided to put it to the test. Now, our friends at Livewire Markets contacted us to enter a competition. WAM Capital, the investment team on the left, for 5 stocks, and AI, 5 stocks. So I'm going to ask you all today, who do you think won over the last 12 months? Put your hand up if you think it was the investment team in WAM Capital. Geez, you know what? How good is that? Like, we were in Canberra yesterday, and I reckon it was like 20%. So I'm going to say it's about 50. Who thinks AI? Okay, it was 50-50. That's better than Canberra, at least. Well, I'm pleased to say the WAM Capital team outperformed AI by just over 20%. Now, if we go back to that last slide, if we look at the left-hand side, does anyone see any common characteristics around the companies that we chose? Could be a sector, it could be a geography, anything. Anything? You can feel free to yell out. There's a bit of tech. We can thank Tobias for that, but there's some telco in there. There's a few different stocks, but largely they're all founder-led companies. And I guess what I'm going to do today in my presentation is talk about why we at Wilson Asset Management like founder-led companies. Now, Wilson Asset Management, as you know, has been around for over 25 years. And as a founder-led company ourselves, we've tended to like companies where the founder owns a substantial shareholding. And this is largely because their actions and their strategy tends to favour the company and therefore the share price over the longer term. When you watch a founder, watch if they're buying. That's usually a great indication of the future. If they're selling, that could often mean that things potentially aren't as rosy going forward. And we've seen time and time again over our careers where a founder sells and that can lead to an earnings downgrade. Now, probably our best example of following a founder when they buy shares is TPG Singapore, or TUA, which has been our best company over the last 3 to 4 years. Now, TUA is a telecommunications company. It's located in Singapore and was born out of the TPG merger with Vodafone back in mid-2020. And as you can see in the share price, it actually performed pretty poorly after that merger. And it was around that time where the founder, David Teo, bought just over $5 million of shares. And I always remember that day. We looked at each other in the team. We said, geez, that looks pretty good. That's a catalyst. We probably need to do some work on this company. So I asked Alice, who's our EA. She booked us a flight. This is Tobias and I. We went to Singapore and we did the work. And we spoke to a number of people in the industry there. And I always remember this one meeting. We had lunch with the second largest telecommunications company in Singapore, and they literally had not heard of TUA. TUA at that point in time had over 100,000 mobile subscribers. So I remember coming out of that meeting, and Tobias and I looked at each other and go, oh, this looks very, very interesting. And so we thought they could fly under the radar, take market share, and certainly that's what they've done. And you can see in that chart, the shares are up quite extraordinarily over the last 3 to 4 years. So you might be asking yourselves, what makes a quality founder-led business? Well, we think there's 3 components here. The first one is obsession. We want to invest in a company where the founder is obsessed with their business. Now, a great example of this over the years might be Ryan Stokes at Seven Group. He's obsessed with return on invested capital for the portfolio of businesses that he owns. Or it could be the Afterpay guys, Nick and Anthony. When they listed, it was all about sales growth and expanding outside of Australia. The second component that we like is an easy to understand business. And this is really important because we've seen time and time again when founders do acquisitions that complicate the story. It can create inefficiency in the organisation and they can underperform. And thirdly, and most importantly, it's management. And this is the management below the founder. Now, to do this, the team must do a lot of meetings. And we do around 4 meetings a day with the 5 of us in the team, and that's around 3,000 meetings a year. Now, experience tells us when we invest in founder-led companies that they have the tendency to materially outperform the market if they are done well. And some great examples for us over the years include Generation Development Group, Regis Healthcare, Pro Medicus, Technology One, Seven Group, Mars Group, the list goes on. They've been fabulous business for us. And as a team, we're constantly on the lookout for the next suite of founder-led companies to drive our performance over the longer term. Now, onto the state of the small cap market. And I honestly feel like a broken record because I reckon I've talked about this numerous times over the years, but the initial public offering market has been horrific over the last 3 years. And it's certainly something we've talked about, but it has been in the press of late. And that chart on the left shows you that it is down around 50% over the last 3 years. But probably what's more concerning is the chart on the right, which shows you the number of listed companies on the ASX. And what this means is that initial public offerings, the number we see every year, hasn't been able to offset the takeovers and the business values that we see in a given year. Now, if we look in WAM Microcap, which is our smallest fund that we manage, less than 300 mil of market cap, we've had 6 takeovers this year, which has been fantastic. It's great. But we've only invested in 1 initial public offering. So that just shows you that we just need some new businesses to list. Now, if we look at the last IPO cycle, which was from 2013 to 2020, there were some fabulous businesses that listed in Australia. And that's the top 10 behind me. Now, if you have a look at the green box, 8 of those 10 stocks were founder-led businesses. So again, goes to my point, founder-led businesses done properly, they can materially outperform the market. Now, it's clearly not going to happen the next few months given the uncertainty, but when we speak to investment bankers, and it's been happening a lot over the last few years, the pipeline of initial public offerings is building, and it's probably the largest it's ever been. Now, what we need to see is this volatility to reduce, but interest rates are trending the right way, as Matt pointed out. So we do think it'll be the back end of this calendar year where we start seeing them and into 2026. And if this occurs, this will be really, really positive for our small cap funds because we just haven't seen it for a long, long time. So this is a selection of 10 companies, I think it's 8 companies, sorry, that we're positive. They're all founder-led that we own across the funds. First company I talk about is Eagers Automotive, which we own in WAM Capital and WAM Active. Now, Eagers Automotive is the largest car dealer in Australia. It has over 12% market share. And like all car dealers, it's been struggling over the last few years with the cost of living crisis and rising interest rates impacting new car sales. Now, despite all this, the business has really come through. Its margins have increased, and we think this is a structural change in the business that can continue going forward. But this business has a great management team. It's a great founder-led business with Nick Politis, and we think the business is primed to make an acquisition in offshore markets such as Canada. So we're really excited about this, and this will be the next phase of growth for this business. Now, the second company I'd like to talk about is Beacon Lighting, and you all probably should all know Beacon. It's a large retailer of lighting equipment and fans in Australia. It's the largest. Now, we own that with WAM Capital, WAM Research, and WAM Microcap. Now, a few years ago, the Beacon management decided that they'd go into the trade sector, which is a $2 billion market. This has been a roaring success to the business. They have around a third of their revenues at the moment exposed here and about 5% market share. So in time, we think they can get to 10% market share, and we also see a recovering retail market, particularly in Victoria where Beacon's strong. So we see a great opportunity for growth for this business. Now, as Matt and Catriona talked about previously, it's very volatile at the moment, there's no question. And this is even more so the case for small cap companies, which is what we invest in across the 4 funds. Now, despite all this, I'm pleased to say that the 4 funds that we manage are outperforming the market at this juncture. So I'm very pleased with how the team has been performing for this financial year and applying the investment process. Now, as we saw in the last period of uncertainty and the sell-off in April to June of 2022, this is a period where us as a fund made some of our best decisions. We looked through the noise, we applied the investment process, and we invested for the longer term. And certainly we see a similar situation today as what we saw back then. And for these reasons, we're very excited as to how our small cap portfolios are positioned at the moment. And we're very excited to find the next suite of founder-led companies to drive our growth over the longer term. So with that, I'll pass it over to Nick and our Alternatives Fund, but thank you very much.
Introducing WAM Alternative Assets, the only listed investment company on the ASX that offers retail investors access to a diversified portfolio of alternative assets such as private equity, infrastructure, real estate, private debt, and real assets. Let's take a look at some of our investments. Darwin Airport is the busiest airport serving the Northern Territory. It consists of an international, domestic, and cargo terminal. Nericon Citrus is a 516-hectare citrus farm located near Griffith, New South Wales. Plantings consist of a mix of citrus, juicing citrus, mandarins, wine grapes, and lemons across 3 allotments. The Somerset Specialist Centre provides leading medical accommodation to specialists and allied healthcare practitioners. The facility is anchored by cancer care provider Genesis Care and medical imaging and radiology provider Q-Scan. Ross River Solar Farm is located in Queensland near Townsville. Built on a 202-hectare site, the solar farm generates renewable energy to power 54,000 homes. Adding alternative assets to your investment portfolio provides many benefits to shareholders, including lower volatility of investment returns, a broader opportunity set, long-term investment horizon, returns driven by both capital growth and income, and more consistent returns across economic cycles. To find out more, visit wilsonassetmanagement.com.au.
Good morning, everyone. Now, before we get started, I wanted to ask a favour. Now, this is my first Sydney Roadshow, and so what I want to do is just quickly take a selfie to capture this moment so I can show my little boys, because I tried to explain what I was doing this morning and they had no idea. And so I thought a photo would be better, so I need everyone who's in this front area to please smile for me. Come on, big smiles. Come on. Perfect. Thank you. My folks will love that as well. So my name is Nick Kelly. I'm the new portfolio manager for WMA, and I'm really excited by the growth prospects for WMA. Now, I've admired this WMA portfolio from afar for a long time, and I think it's a bit of a hidden gem. Now, there are 3 key reasons why I've admired this portfolio so much. Firstly, we own high-quality assets that are absolutely integral to our everyday lives. We provide access to an institutional quality portfolio to absolutely everyone. We democratise alternatives, and I'll talk about what that means shortly. And finally, we know that adding alternatives to an existing portfolio of equities and bonds will create a smoother investment journey for you. So let's first bring to life these wonderful assets we own within WMA. So let me first introduce you to Alex. Here he is. He's a good-looking young man with a strong jawline. Now, I should say Alex is completely fictitious. I've made Alex up for the purposes of these exercises. so no need to ask any questions during the panel on Alex. Now, beyond Alex's good looks, he's also a university student at the biomedical campus at the University of Sydney. And he spends most of his day looking through a microscope. Now, most days, Alex likes to head out at lunch to get some fresh air. And his favourite thing to do on a Friday is to go to Betty's Burgers and grab himself a shroom burger and a boost juice on the way back to the lab. Now, on this particular Friday, Alex finishes up early and he heads out for a haircut. Keep himself looking sharp. And at the end of that session with a hairdresser, they put in some product in his hair from NAC Hair. And now WMA owns all of these businesses. So you can see just how central we are to Alex's life. We own the biomedical campus at the University of Sydney through our investment partner Wentworth, which will become the preeminent research and development lab for the university's medical students. We own Boost Juice and Betty's Burgers, establishments that I'm sure most of us have either dined at or at least familiar with. And finally, we own NAC Hair, which is a business which supplies on-trend hair products to salons across Australia. Now, this is just a small snapshot of the businesses we own within WMA. And in fact, we own over 130 different businesses and assets which play an integral role in our everyday lives. Now, changing tact. So on the left-hand side of this slide is a pie chart displaying the average superannuation balance fund asset allocation. You can see here approximately 50% is allocated to equities, represented by the blue parts of this pie chart. There's a further 8% allocated to cash and fixed income, represented by the yellow piece. And there's over 40% allocated to alternatives. And that allocation is made in a very similar way to the WMA portfolio. Now, this isn't new, okay? Institutional investors have been allocating their capital this way for decades. However, up until recently, retail and wholesale investors were unable to access the entire breadth of this asset class, but that has all changed with WMA. And that's what we mean by democratising alternatives. We're giving everyone access to an asset class that was previously inaccessible. Okay, we're levelling the playing field, and that's something that really excites me, and it excites me because we know that the only free lunch in investing, other than the one we will provide shortly, is diversification, right? And so adding alternatives to an existing portfolio of bonds and equities can help improve the risk-adjusted return on your investment portfolio, and I'll show you that now. So on this chart, we have graphed the return and the volatility of the ASX All Ords Accumulation Index between October 2020 to February 2025, which is the period that we have been managing the WMA portfolio. You can see here the return on the index over that period was 12%, and the volatility on an annualised basis was 13%. Now, what do we mean by volatility? Volatility is simply the dispersion of a portfolio's returns around the long-run average. Now, it's important to note, it is a measure of risk, but it is not the only measure of risk, and its importance will differ for different investors. So as a retiree, for example, you might have a shorter investment time horizon, and so volatility might be an important measure of risk for you, or equally, an investor with an overall lower tolerance for risk will typically see volatility as an important measure of risk. Now, what happens when we add WMA to this chart? So you can see here that the underlying investment portfolio for WMA has delivered 9.3% annualised over the same period relative to the All Ords index. But perhaps more important is that reduction in volatility. So you can see here the volatility on the equity index at 13%, and the volatility of the underlying WMA investment portfolio is 3.5%. And for me, this is really the aha moment. So you can see here that if you were to pair an existing equities portfolio alongside WMA, you can reduce the overall risk in an investment portfolio. So hopefully by now you're starting to see what I have admired from afar. High quality assets that are absolutely central to our everyday lives, access to an asset class that was previously inaccessible, and adding alternatives to an existing portfolio of equities and bonds will create a smoother investment journey for you. But there's one final question to ask, and that is why now? And the answer is here. It's the 3 Ds. It's diversification, dividends, and discount. Now, I've already touched on the diversification point. On dividends, we're paying a 5.6% fully franked dividend. We have over 3 years of dividend coverage. And this portfolio is currently trading at a near 20% discount to NTA. Frankly, I don't think the timing could be better. This portfolio is poised for growth, and we have cash available to go after opportunities that we're seeing that's been created by the noise that you've heard about this morning that's occurring in markets today. As Warren Buffett famously said, be fearful when others are greedy, but be greedy when others are fearful. And we think there's some wonderful investment opportunities within the WMA portfolio to go after, given the noise and uncertainty we're seeing in markets today. Thank you very much. I'm going to welcome Geoff up on stage, and he's going to moderate a panel on the WAM Income Maximiser. Thanks very much.